I think the big shift, really, I know the presidential horse race is very tight. Two things that derive from that. The first is there should be a little bit of an uncertainty premium that starts to sneak into markets. Until Q3, markets typically ignore the elections, and then over the summer it starts to build up. And until markets can price the outcome, that uncertainty discount kind of keeps a lid on risk assets. But the second big movement really is because Harris replaced Biden, that the odds of a divided Congress have gone up a lot. And therefore the chance of a significant fiscal expansion have receded. And that means that some of the moves in the bond markets should be a little bit tempered.
Interesting. Fiscal expansion receded, but we're not talking about any attempts to tackle government spending. And Musk was right to pick up on that point, because while it may not have mattered for bond markets, it gets to the point where I think many of us are concerned that it will have an impact at some point. And the reality that, look, fiscal spending doesn't always equate to economic growth. In fact, it can crowd out other participants.
Well, we spent a decade about how central banking monetary policy was the only game in town. I think the coming years we will focus a lot on fiscal policy, fiscal dominance, and the fact that that's going to be a market driver. Now, with regards to the U.S., the problem in the U.S. is that revenues as a share of GDP are historically low. So yes, of course, you can adjust expenditures, and there probably has to be some review. But ultimately, tax revenue will have to go up in some shape or form, either through the backdoor expiration of past tax cuts or more explicit revenue-raising programs. There is no alternative to that. The fiscal problem is going to get acute in 2025 because debt servicing costs are going up. Remember that the average maturity of treasuries is 7 years. That means half of that has to be refinanced at higher interest rate costs and no longer kind of the zero interest rate environment that it came from. So that problem, even if you have kind of fiscal stability, is going to get worse.
What do well-timed interest rate cuts look like right now? I mean, that's pretty much what we're seeing in your notes, but what does well-timed mean right now? Because the Fed will feel like they've navigated this as well as possible.
Well-timed, I think, at this stage means they got to go in September. Markets are expecting it. I think when you look at the cracks in the U.S. economy, the economy it needs that easing. Rates are clearly in restrictive territory. It's starting to cause pain and damage, and therefore the central bank has to respond to that. Well-timed, I think. We are not in the camp where we think there needs to be an emergency cut or a 50 basis points cut, but I think the beginning of the rate cutting cycle that we've all kind of been waiting and hungry for quite some time.
But is that 3 cuts this year or is that 2?
That's 3. Okay, that's 3 this year and then a few more next year.